Hello everyone, welcome back. In this session of our Prospectus 2021 virtual conference, we're going to be discussing the capital situation across both reinsurance and insurance-linked securities, focusing on constraints seen, challenges faced, and also successes won. We've got a great group of panelists with us today with experience across the sort of reinsurance, ILS, and investment markets. We have Stefan Ruoff, the head of Fraudus Aguero. We have Henning Ludolfs, Managing Director, Retrocession and Capital Markets at Hannover Re. We have Greg Hagood, co-founder of Nephila Capital, and John Butler, Managing Director at Cohen Company. There will be a chance for some live Q&A, I hope, at the end, as long as we leave time for that, so the audience can submit their questions as we go along. Going to move straight into the questions rather than giving you too much background here. And I thought to begin, we'd just get each of our panelists to give a bit of an overview of their position in the market and how or why they interact with investors. So can I turn to you, Stefan, first, please?
Yeah, good afternoon, good morning, good evening, wherever you are. Well, thanks for having me on the panel, Steve. So representing Fraudus Aguero, we are an ILS manager. We are a result of a merger, which means Fraudus has acquired the Aguero ILS management company over the past few years. Today, we're belonging 100% to Fraudus, and we're an institutional, independent, and obviously not conflicted ILS manager within a broader framework represented by Fraudus and its private asset practice. Now, the way we go to the market, we look at the market probably in three categories. One category, we qualify the liquid side, i.e. the cat bond space. Another category, we qualify the illiquid space, which we occupy with what we call life ILS, so mostly value in force transactions, probably some mortality. And then what we call the third area is the in-between, and we go to market in between with broader ILS strategies that do combine different elements of the broader ILS universe or the reinsurance world, actually, if you mean so. From a positioning perspective, I think one can say we're certainly very strong in the cat bond space, running one of the larger UCITS funds in the space. And we're also, I think, becoming one of the larger life ILS players in the world that is obviously ramping up that side of its business as well. So I'll stop here. That's probably enough of an introduction, and then we'll certainly add to that over the discussion. Thank you, Steve.
Thank you, Stefan. And John, perhaps turn it to you.
Thanks, Steve, and thanks everybody for joining us. I am the managing director of Cohen Company's insurance asset management practice. Cohen Company is a 20-year-old New York-based asset manager, part of a broader group of family holdings, which come from the original banking practices of the Cohen family. We're perhaps a little different from the rest of the panel here in that we're not particularly actively involved in the ILS space, but we have for the last 18 years been a significant provider of capital and investment to the insurance industry. We are the longest running and probably the largest provider of private debt transactions to small and mid-sized insurance companies in Europe and the US. We interact with investors there by raising funds from institutional investors, both in the US and Europe, to deploy illiquid transactions, longer-term illiquid transactions into the balance sheets of insurers. These are transactions which often have a 10 or 20-year duration. Alongside that, we're also a significant sponsor of special purpose acquisition companies. They are, I guess, for the insurance market, a relatively new construct, but you can effectively see it as an alternative for a private company to go public than a traditional way IPO. We've been, over time, probably the larger, one of the very largest of the sponsor groups for SPAC since the redevelopment of that market in 2015. And we manage a series of SPACs under the INSU brand, which target enterprises involved in the insurance market. So it means that we interact not only with private investors on the debt side of our business, but also with public markets investors looking at what is attractive from within the insurance market. And then alongside that, we certainly have a perspective to ILS. I've been an ILS manager and a reinsurer longer into my history, and we always look at interesting ways to potentially interact with our investors in indemnity transactions as well.
Great, thank you, John. And then moving on to Greg.
Good afternoon, good morning, Steve. Thanks for having me on the panel. My name is Greg Hagood. I am the co-founder and co-CEO of Nephila Capital. Nephila Capital is an ILS manager. We began our company in 1998. There are three components to our business. We started off as a catastrophe-only manager, so just lived in the reinsurance space, and that's evolved over time to not just reinsurance, but we have an insurance platform as well now. So our catastrophe business is participated in both insurance and reinsurance. The second part of our business is we manage a climate business, and climate is outside of the catastrophe space, but it's effectively providing risk transfer to renewables, agriculture, hydroelectric, things of that nature. So it's a separate pool of risk where we speak with investors about investing in that sector. Obviously not correlated to stocks and bonds, but also ESG friendly and impact oriented, and certainly a lot of conversations around that. The third leg of our business is a platform at Lloyd's of London, not only to help facilitate our catastrophe business, but separately from that, we've launched a separate syndicate that's very focused on non-catastrophe business. So things like cyber, terror, aviation, insurance lines that are not catastrophe in nature. So our interaction with investors could be in isolation or silo to speak about just catastrophe or just climate or just non-catastrophe, or potentially some combination of the three. We have about 240 people across the company, and that's a quick summary of our platform. Steve, thanks.
Great, thank you, Greg. And Henning, finally, over to you.
Thanks, Steve. Henning Ludo is my name. I'm Regroup, and I lead a division called Regroup Capital Markets. To protect the Hannover Regroup. We buy insurance, and we buy a significant part from institutional investors and ILS investors. This back to 1994. The other department, which we call insurance securities, is a department to service ILS investors, facilitate the transfer of risk to investors. This includes collateralized funding, transformation of catastrophe bonds, and also life risks, though life risks have more private transactions. We also we are anchor investor in a little ILS investment company in Luxembourg, investment, $200 million invested in ILS, which is all Hannover. These would be my links to the ILS world.
Thank you, Henning. So we've got a good group of perspectives from across really the reinsurance and ILS side of the industry here, and obviously everybody working with investors in some form or another. Now, obviously we've got a pandemic affecting the globe at the moment, and this has affected investor appetite across numerous asset classes, as well as in ILS and reinsurance, and also for certain areas of the debt and private equity markets as well. I guess it'd be interesting to hear from each of you briefly sort of how this affected your operations, and sort of whether you see that as a sort of short-term impact, or whether you still see certain impacts today from the uncertainty related to the pandemic. Perhaps we could start with Greg.
Sure. I mean, what's going on right now in the last 12 months has been fascinating. I reach back into some of the history lessons that if you think about what happened around 9/11, the terrorist attacks around 9/11, you had a situation where the market was impacted, that multiple lines of insurance were hit from the same event and impacted on the liability side pretty materially, while the stock market was hit at the same time. So there's some parallels with that with today. If you think about 2008 and the global financial crisis, obviously a high premium on liquidity, asset side of the industry balance sheet was strained. There's just a lot of uncertainty. And if you look at the parallels to what we've seen around the pandemic, very similar things, particularly in February, March, April, when there was a whole lot of uncertainty in the early days. Big demand for liquidity, multiple lines of insurance hit from the same event. So some similarity to the past events. The thing that was probably different was with the pandemic and with COVID, there was obviously some coverage issues in the insurance industry, what was covered, what wasn't covered, what potential lawsuits there would be. So, a lot of time spent with investor education on how pandemics are covered in the industry, and in particular, how it's covered in the insurance industry and how it's different in reinsurance and how that might be different in retro, and the implications thereof for trapped collateral and so forth, which we'll talk about later. But we spent a lot of time with investor education around how pandemic is covered in the industry. We saw some very similar things to previous events like this, where big demand for liquidity, cat bonds sold off. Some investors across the globe had a high demand for liquidity and saw their broader asset pools get impacted, and so they had a need for liquidity through some redemptions in the market. The good thing is, we have an experienced team. We've been through some of those events that we've seen before, and anytime you have a crisis, they're always slightly different, but there's a lot of parallels to previous ones. But this one has definitely been fascinating and continues to be going into 2021.
Sure. Thank you, Greg. Henning, from your side, has the pandemic sort of impacted any of the activities that Hannover Re undertakes in the ILS market?
On the retrocessions, we are on discussions with our records, as there's still a lot of uncertainty. The uncertainty is probably a bit less in March, April, but still a lot of uncertainty. And these are, of course, ongoing discussions. Generally, I have not yet seen addressed in respect of the support from the ILS market. Some investors have probably and trapped capital. Others are stable, and others again have money inflow. So no dress changes. I expect on the retro side interesting and probably challenging renewal discussions, but I'm reasonably optimistic. I believe there is capacity there, and I'm not able to manage it. Of course, we have term relationships and trust which will help us. However, we would have a similar situation even without a pandemic. The last 3 years, 2017 to 19, there were a lot of losses. There were crises like loss creep, the trapped capital. So I believe the situation is not that different. Pandemic on top now, which is another element. Again, we see drastic changes, but of course, it's another element of discussions.
Thank you, Henning. Unfortunately, Henning, your connection is really not particularly clear, so we'll try and persevere, but it's a little challenging to understand, unfortunately. So I'm going to move straight on to Stefan. From your side, are you finding that investors are beginning to move beyond the initial uncertainty caused by the pandemic?
Yeah, it's an interesting development since March of this year, and I think it was alluded to. We saw in March an interesting reaction of the asset class, because the asset class held up well and was then used, and I said this before, as an ATM for some other asset classes, because it was a liquid one, especially on the bond side, actually. But since then, I think for us, what happened at that very moment, and immediately when COVID rolled in, we felt it is very, very important to create transparency for investors, actually. And I think Greg mentioned this as well, actually. Investor education at that very moment was probably at the forefront of our minds. And this in terms of how do we value each and every position, how do we value each and every instrument in which the investors put their money, actually. Because I think what we've seen over the last 3 to 4 years was we've played with some of the trust investors had given. And I think the asset class has grown up and has understood that it needs to be transparent and it needs to be clear on what it can and what it can't do. So for us, it really meant in the first weeks to go through the entire portfolio to find a way to properly assess wordings, values, possible impacts on each and every position, actually. And obviously, the different segments I alluded to earlier had different levels of impact. If you can imagine, a mortality bond can have a different impact than a cat bond that is purely earthquake focused, actually. So there's a huge range in that. And based on that, we developed investor information sessions where we took them through their portfolios in order to make sure that they really understand and lose that, let's say, fear that they had running into something they had experienced previously. The other thing I think we also did was looking at what is the opportunity this creates for portfolio construction 2021? Because let's say COVID-19 is probably another building block in the market that leads to a development that has already started, but is now really strongly happening with price increases, capital restructuring, which in turn does create opportunities for investors. So thinking ahead and how you build portfolios going into 2021 has also been at the, let's say, at the considerations we took up then.
Great, thank you, Stefan. Yeah, that was a point that came up in a panel earlier today, that really the way you construct portfolios going into 2021, you need to really keep in mind the transparency and clarity for your counterparties plus investors. So moving on to John, from your side, obviously slightly different investor proposition. I'm assuming that you still felt the same sort of level of uncertainty and volatility in the marketplaces, but how is that coming back on your side with the ways you deploy capital into insurance?
Yeah, we certainly did, and I think the early effects that we saw, particularly in the private debt side of our business, very much echoed what everybody else has said about the ILS market. But there was clearly concern from investors about what this meant for the security of the insurance companies in which they were invested, and what it meant for the market as a whole, and really what it led to. It led to us sitting back and taking a period of time to understand and work through the effects of the COVID situation and where losses may come from and how it might affect ultimately the balance sheets of carriers, both on the insurance and reinsurance side. I think we're lucky we have a good team of specialists we were able to work through and really work with our investors to give them an understanding of first of all, what it meant, which luckily in our case was not a significant impact for the positions that we were invested in, but it did enable us to identify certain particularly sensitive areas that we might be more cautious of going forward as things change in the market. But really, ultimately, what it led to was an ability to educate investors that ultimately that sort of opportunities grow from the situation. Certainly, insurers are becoming more conservative about the way they manage their capital and the way that they're looking at the potential effects of COVID claims. They're also now facing a hardened reinsurance market, which means that they may look for other forms of capital from other places, including raising things like debt capital. So ultimately what it led to is an acceleration in pipeline conversations around people thinking about how they grow the more permanent capital on their balance sheet rolling forward. And it's led, I think, to an increased opportunity set for investors on this side. So maybe from our side of the business, there's been maybe a faster take-up or a faster acceleration into the growth phase of the business, sort of rolling forward from this situation and thinking about how we help the insurance companies that we work with to build into this and mute the effects of the cost of the capital in other areas of their balance sheet. So, I think, the effect now is oddly relatively positive in terms of where it's creating market for products like ours. I think the more interesting effect maybe is even within the SPAC market. Special purpose acquisition companies had been a feature of the US public markets, particularly for a period of time, but we used in particular cases, and there were a smaller number of companies or investors specializing in sponsoring these vehicles. What we've seen post the volatility of COVID in the public markets is an explosion in the use of SPACs as a means of going public for industries across all sectors. It's not particularly an insurance effect, it's a US public markets effect very broadly. That's led to 2020 being the largest year, the biggest sort of bumper year for the market in terms of issuance of these vehicles and in terms of transactions being closed. And it's really down to the technical differences between going public via a SPAC and going public via a traditional IPO, which leaves a SPAC transaction being a more discursive process with investors, allowing a company to walk across investors and understanding their reception in the public markets in significantly more detail than they would do in a traditional IPO. So in a more volatile market with more question over potential volatility of pricing and investor appetite, it's become a means of going public with a great deal more security around the reception of the company moving forward. So, effectively the issuance of SPACs, the sponsorship of SPACs has become, from, a very good, very attractive line of our business, it's become almost the dominant part of the business for Cohen Company for the time being.
Sure. Yeah, no, it's interesting how certain areas of the market bounce back quicker than others. Stefan, turning to you again on the cat bond side, obviously we've seen a bit of a resurgence, and I think we wrote last week that we've already seen the largest number of transactions in a single year so far in 2020, and we're very likely to break most of the other records, I think, in 2020 as well. Do you see that this is, why do you feel investor confidence came back so quickly in that space? And is this something that really the market, particularly on the cedent side, should be trying to capitalize on if there really is good investor appetite there?
Well, I think the cedents already try to capitalize on it, actually. And but I think, let's have a quick look at the broad picture, actually. So ILS, but specifically the cat bond market, has proven to be a relatively uncorrelated asset class in itself, actually. It's created, meanwhile, returns over a long period of time, and you can track them back to 2002 or even longer. And if you look at the period, there's a huge stability of returns generated over that time, actually. So overall, the asset class has quite some nice features. So then you put on top of it that we have an interest rate environment, globally speaking now, that has gone close to zero for most of the developed economies, actually. It does also, I think, push interest to other areas that can provide more yield. And then COVID-19 has basically proven that the cat bond space can come out of it without much harm done, or any harm done to some extent on the cat side. All that brings, obviously, an environment where investors really like the cat bond space. And this is what we do observe as we speak. We see relatively, let's say, important inflows into the area. The downside to that will certainly be that prices or price increases that we have seen in the cat bond space of the last, let's say, 6, 12, maybe 18 months even, may not continue in the same way. And obviously, that's why I was saying at the beginning that you have cat bond capacity available for seeding companies, which I think is a great thing, because this does provide capacity, it does provide capital to certain areas of the market that are in need of capital. So I think broadening the capital sources and offering risk transfer markets more than just reinsurance or retrocession through the direct access to capital markets is a great thing, actually.
Absolutely, yeah, and we've seen some very interesting sponsors come to market this year, not least Google in recent weeks, and I understand there's potentially a few more surprises to come later this year, I keep being told. So there's areas of the market that are bouncing back and seeing good investor demand, and then on the sort of more collateralized side of the ILS market, things have been a little slower getting back sort of to normal, but that's not just to do with the pandemic. It's also to do with the sort of the overhang of recent years and the threat of obviously trapped collateral as well. Greg, if I could turn to you, do you see this as a sort of natural cycle of appetites within investors within insurance and reinsurance as they're still learning about the overall marketplace? And how are your investor conversations going at this point in time with a view to year end?
Yeah, I mean, obviously, COVID and the trapped collateral issue is a real issue, and it's a concern because I mean, COVID's still ongoing, right? So you get all kinds of complications that surround that. It's basically a live cat, for 9 months. So you've got some serious contract wording issues. The further down the food chain you go, it's a little more clear in insurance, it's a little less clear in reinsurance, and it's a little less clear as you get to retro. So depending on where you play in the market, and in the cat bond market, it can be more clear for good reasons. So, there's a lot of things that are related to that. So investors are certainly concerned about that, concerned about, potential claims, potentially about that collateral, potentially about how that's all going to play out and in what time frame. So that's one thing that investors are talking about. The other thing people are talking about a lot is certainly climate change. That's very much on investors' minds. And, what's the industry doing to deal with that? What are the catastrophe models doing to deal with that? And how are you communicating that to investors and so forth? And getting a lot of questions about performance the last 3 or 4 years. I mean, cat bonds have probably outperformed the broader sector the last few years. Generally play a little higher in the capital structure and kind of be the top layers of the insurance, and kind of the collateralized reinsurance stuff is a little more in the money and has had a few more claims from the last few years. So, there are different parts of the distribution where cat bonds outperform, and there are different parts of the distribution where collateralized reinsurance outperforms and so forth. So that's an investor education thing to understand, the strengths and weaknesses of both. And obviously what we do is try to be as broad of an investable universe as we can and participate in all segments when they're most attractive. But so it's obviously been a more difficult time the last 3 or 4 years for the whole sector. But at the end of the day, I think investors still like the overwhelming attributes of the asset class. It's not correlated to stocks and bonds. As Stefan said, interest rates are low. This has some yield. I think what investors are spending time considering is what's the best way to participate in the sector. There's a lot more ways to participate in it now than when we started in 1998. And, it's in some ways great because there's more venues in which capital can flow. In some ways, I think some investors find it confusing and trying to figure out, which is the best way and what are the strengths and benefits of a cat bond only fund versus a diversified ILS manager versus a sidecar versus a retro only segment. That's a lot of information to digest for someone who doesn't live and breathe the reinsurance industry every day. So, those are some of the big issues we're talking with investors at this point.
Greg, thank you. You can probably hear in the background of my microphone that my fire alarm has just gone off in my office, literally at this point in time. Can I ask, John, could you possibly talk to the audience a little bit about some of the other ways that you see capital appetite coming back to investors? And then perhaps you could hand over to Henning while I just go and find out what exactly is going on here. I will be back in a moment. Apologies for this.
No problem. I'm very happy to do that. Thanks, Steve. So I think in terms of the businesses that we operate and the ways that we manage capital into insurance balance sheets, then I think, 2 major themes which come through our business, maybe firstly on the private debt side is, investors are very happy to invest in the insurance industry where they see opportunities to do so in areas which are showing significant improvements in rating post-COVID and where opportunity sets are growing. And I think that there is a feeling from investors now that supporting well-known established franchises, with quality underwriting results, through the cycle makes very good sense. That they see the robust nature of the insurance market overall, the long-term nature of the insurance business, that it is well regulated, that it is a very transparent industry. And I think that shows in terms of, an appreciable capability to define which businesses and which sectors may be more or less affected by COVID-related losses, but also COVID-related and other factors, bringing about rate hardening over the coming period. Our investors certainly have shown a strong interest in bringing capital in to assist those corporations moving forward. And, I think, through the ongoing insurance industry and also through, what is now a very strongly growing legacy market, we see very attractive opportunities to invest moving forward. And I think our investors now feel that there is sufficient clarity to understand, how this has been affected by the current situation and what the changes will be moving forward. I think, a theme that comes out very much when I talk to our public investors within the SPAC practice is the thought around how the COVID situation not so much has affected losses and reserving with the insurance balance sheet, but how it's affected the interaction between the insurance reinsurance market as a whole and its ultimate consumers, and which business models will ultimately benefit more from a situation where, maybe consumers can't get to a bricks and mortar agent and they're having to access their insurance product online. The insurance market has maybe been behind other financial sectors in thinking about technology and the application of technology through the value chain, but particularly towards consumer distribution. And I think, public markets investors, we see, less attracted maybe to the very, very traditional balance sheets, but very attracted to the concept of highly performing niches, areas which should grow rapidly through the coming cycle, but also, how that might be driven by the application of new technology to the handling, processing, analysis of risk in the market. And I think maybe the acceleration of investment into those types of franchises will be a theme that we see running through the next years.
Thank you, John. Apologies for that. It appears it was a false alarm, thankfully, so I can carry on. But thank you for taking over there. So I'm going to turn to Henning. Henning, perhaps you could talk us through. You obviously, Hannover Re, support ILS funds in accessing risk by fronting for them. You also obviously use third-party capital on the retrocession side quite extensively. Has the evolution of investor appetite through 2020 affected Hannover Re very much at all? And do you see particular signs of a recovery?
Well, I hope that all can be reasonable. I will try to speak a bit more. Yes, we work on the Hannover Re side on various ends with ILS investors on the side as well as on the transformation side. We haven't seen any drastic changes. We have not seen that majority of investors are really different views. And I think, and most investors we speak to think that the theme, the actual topic of story of ILS is still. So if intro up, it doesn't cause an earthquake. Or if you have turmoils in the financial market, it doesn't cause natural catastrophe. Yes, we have now a problem of insurance, reinsurance risk, COVID, impacting the financial markets. Probably no one thought about this really before. But this side of the non-correlation has never been the big, because earthquake or a major hurricane happening may and will also have an impact on the financial. So the non-correlation is really on the right, and this is proven, I believe. It was 2008 the case, was and 2020 the financial fluctuation in the market, which were causing the issues. So I think ILS story is intact. I believe that the investors will, or all investors we speak to, see it the same way. If, at the end of this year, we may be a bit down. It will be challenging, but a longer, I believe the ILS will grow again. Well, on the cat bond side, which Stefan has mentioned already, but I believe also on the collateralized reinsurance side, for example, advantage, you can easier get access to diversity. In the cat bonds arena, you have not that many diversifying risks. On the collateralized reinsurance, it's a bit easier to build up the portfolio. So all pros and cons. I'm optimistic.
Good. So going to move on to Stefan. We've seen some evidence that there will still be capital constraints going into the renewals, in particular in the retrocession space is the one that obviously everybody's been talking about. Is this a clear opportunity for those who are able to raise capital and structure it well? Or do you feel the retro side perhaps has been overdone a little in recent years and perhaps investors would be wise to look elsewhere? What's your view on that side of the market?
There were probably 3 or 4 questions in one. Let me try and so first of all, yes, I think the retro space does present an opportunity for investors actually, and I think you started to put it right. I think the retro space has suffered from a number of things actually. It has lost probably 30% of its capacity over the last few years. Hence, replenishing that will be something challenging to do actually. But the question then becomes, why has that happened actually? And it has happened, I think, because of a number of reasons. First of all, we've had, let's say, pricing probably not being right. But much more importantly, I don't think that structures in place have done the market a favor, actually, be it aggregate structures, be it step structures, or you have me, actually, we've seen these structures, let's say, failing to the point that we've seen even managers leaving the space. And that was then also accompanied by wordings in the retro space, and this is an effect that we now see with COVID-19, that are, let's say, not well checked or too wide, that also, again, lead to collateral trapping. So here, I think the retro space needs a very, very close look. Now, I think it's not just a matter of new capital coming in. I think you can well restructure an existing capital base in a fund that can take advantage of the opportunity at the moment, actually, because you may redeploy from, let's say, one ILS, call it universe, into the next one, which is called retro, by positioning the portfolio differently than you do right now, actually. So I think there are ways to fill the gap that is in the retro space, and I think it will represent an opportunity. But I caution, and we have very, let's say, intense discussion with potential investors or with existing investors when they ask, what do you do when you go into retro space? So positioning it rightly, let's say, getting over the information asymmetry you have in the retro space because you're relatively far removed from the risk are essential points to be addressed. So that's to that part. The other part is it the only opportunity in the space? No, certainly not. I think the opportunity set in the ILS market or even in the broader insurance, reinsurance, risk transfer world, as presented by John, I think at the moment has, let's say, rarely been that good since many, many years.
No, certainly that seems to be the perspective that most people in the market have right now, is that well-structured opportunities are available everywhere, but the term well-structured does keep coming up, which I think is also quite positive, I hope. Greg, moving on to yourself, I mean, obviously with the change in sort of investor, the experience they've had in recent years, and then now in 2020, has your approach to marketing to investors and educating them, has that changed? And are you communicating with them in the same way, or is that possibly a more frequent job these days?
Well, I guess I would say, obviously we've been doing this a long time. What I've seen the last 5 or 7 years in particular is, it used to be a conversation 15 years ago about what is reinsurance, what is a cat bond, how does this work? Now most of the investors we speak with know the space pretty well. Like, they know the different segments of the market, they know the strengths and weaknesses as positioned by various people in the market. And now a lot of our discussions really come down to more like our platform. Like, what does Nephila bring to the table? What's Nephila's edge? How do we bring all this information to bear to build better portfolios? So that's definitely going to change the last 5 or 10 years in particular. More recently, the conversations have been more frequent for obvious reasons. There's been a lot of loss activity, there's been loss creep, there's been COVID, there's been uncertainty in the markets. For sure. And I guess one thing, we very much position ourselves as a fiduciary of capital. We're a fund manager, our client is our investor, and the people we trade with are counterparties. And I mean that respectfully, but our clients are our investors, and we are fiduciary for capital. So we have a very high standard for how we manage that. And in the fund manager fiduciary capacity, we really value things like Stefan said, transparency is very key. Making sure they have full transparency into the portfolios and have any surprises. They understand what risks they're covering or not covering. We could have done a better job as a manager at Nephila on COVID related to that. And I think I would suspect most people in the industry could have done a better job on that, but that's a lesson learned and we'll incorporate into our fabric going forward. So I think it really just boils down to making sure you know who your client is, making sure you treat them as a fiduciary, making sure you give them transparency, and just making sure the surprises are as few as possible, and hopefully no surprises, but that's difficult to do. But there's been a lot of conversations, and I think the investor base just broadly is more educated on the space, and it's less about the blocking and tackling and more about the value add. And just the final thing I would say is there are certainly people in the space, investors who are more strategic, and we all know who those people are, and they've been in the space and continue to be in the space, and they'll probably ride out the cycles with some tweaks. And then there's a fresh wave of new people who are exploring the space, and then there's a third leg, which is more the opportunistic people who might come in, after spreads widen for a while and stay for a year or two and leave, and that's quite healthy. But we're definitely seeing a bit more of a segmentation on strategic and tactical type people in the market, and the positioning changes relative to their interest.
And that's obviously a very interesting dynamic at the moment, that the investor base maybe will look a little different into 2021 than it did or at the beginning of 2020, I would imagine, which is probably not an unhealthy thing either, though, because people do have to cycle in and out of different strategies within their portfolios overall.
And we did see this after 2004 and 5 with the hurricanes in 2004 and Katrina and Rita Wilma in 2005. You get a very similar vibe in the market where people are talking about climate change. Opportunistic people came in, strategic people were a little more wounded and how they felt about it. So it's interesting to kind of reach back in time and see how the parallels are here. But I would say the investor base broadly is broader and more educated now than it was at that time in 2004 and 5 going into 2006.
Sure, yeah, and I guess the depth is there, which perhaps makes the sector more resilient to this as well this time around. John, moving on to you. I know obviously at Cohen you said there is interest in ILS and you have a great deal of experience in this area, but you said before that you haven't yet identified the mode of entry that's really attractive for you at this point in time. Do you feel there's another way that can help to rekindle or build even more investor appetite within the reinsurance market? Are you hoping to produce something that we haven't seen before, perhaps?
I think I would hope that we always do. I think probably what we don't need is somebody else trying to produce something that everybody else is doing and that we've all seen already, because what use does that serve the industry and what use does that serve investors? There are already exceptionally good quality managers in the market, concentrating on the types of risks that we've already principally seen, particularly catastrophe risk. And I don't think there's any point for any new manager coming in trying to offer more of the same at this point when there's such a well-established market. I think our thoughts really echo a little bit of what Greg was just saying in terms of knowing your investor and knowing what your typical investor base wants, and wanting to continue the good quality service that they already have, but giving them participations in the market which really echo what they see from us. And clearly, as principally a fixed income manager to this point, looking broadly across multi-line insurance companies, we tend to have an investor base who are maybe more used to a smoother, less volatile result from a broader blend of underlying insurance risks. But investors who are also prepared to potentially commit capital for longer periods of time than the liquidity given by the cat bond market or even the annual standard treaty renewal cycle for short tail lines from the cat side. So I think, when we think about ways to bring our investors closer to, risk transactions, we're really thinking about, when can be the right time, what is the right shape for a portfolio, which is much more diversified in terms of the types of risks which it is taking. So looking maybe away from cat on the short tail side to think about, cyber, terrorism, marine aviation, fire, the other short tail lines, and whether they now represent more of an opportunity to a broader range of investors. I think certainly we've been interested to keep conversations with institutional investors and others who are directing institutional assets into the ILS market, who have been very happy with very concentrated catastrophe risk for this last period of development of the ILS market, but maybe who have seen in the last 2 or 3 years that having all of that concentrated in some particular peak areas does lead to volatility. It does lead to trapped capital and a greater volume of trapped capital. Maybe the argument that if it's only 1 or 2% of your overall portfolio, it doesn't matter if that's then invested in concentrated risk. It is holding less well at the moment, and we see more of the people who were maybe the promoters of that thought over the last few years now moving towards, investigating how they can look at other areas and other types of risk. I think with a view to investors who are, maybe more long-term in their perspective, we're also investigating, what is, the newer technologies of casualty risks into this type of market. I think it doesn't necessarily suit the traditional catastrophe investor, but there are certainly investors for whom this may suit. And if you're used to committing capital for 10 or 20 years to a transaction, then something of a significantly shorter time frame can work in those markets. So I think there are ways to think about new forms of risk. It needs maybe investors with a different perspective than the traditional ILS investor that we talk to day in, day out as ILS managers. And maybe, for us as a manager who comes at this from a different corner of the market with different types of investors with a different overall appetite, it's more natural for us to think about these types of concepts than maybe, others who are more involved and more ingrained into the short tail catastrophe area, who have an investor set who are very happy and very cognizant of the volatility in that market, but also very happy with defining returns from those areas. So I think that there are ways that we think about doing that. I think, more broadly, we're also very interested, as I mentioned earlier, through the SPAC practice of thinking about how technology changes the distribution of insurance over the coming cycle, and how, ultimately the relationship between the wholesale capital provider and the retail consumer is affected and maybe brought more proximate by the upcoming structural changes in the market that we are beginning to see. Maybe the challenger insurance company as opposed to the challenger bank, but the insurance industry is maybe half a decade behind the banking industry in terms of these types of technologies. So I think also thinking about how investor capital will ultimately support risk in this new environment, as opposed to how it fits neatly into the old layers of retro reinsurance, primary insurance that we're all used to, is something that we're very much looking at and thinking about the right way of investing in those structures.
Yeah, and that's obviously a very interesting possible avenue the market will go down in future years, I suppose, as technology does become much more wholesale used throughout the marketplace. So it will be interesting to see how capital connects with that risk and the opportunities that brings for everybody in the market. Moving briefly to one of the sort of longer standing structures in reinsurance, the sidecar vehicle. It's not been the easiest one to bring capital into in the reinsurance and retrocession market in recent years since the sort of 2017-18 losses. But obviously, Henning, you're a significant sponsor of a sidecar structure. How is the fundraising market in that area at this point in time? Are you confident that's a place that investors continue to want to support large sponsors like yourselves?
I'm fairly optimistic for our case sessions. For the reasons we have with many investors and protection providers long-term and very stable business relationships, and we have a track record which goes back to the first ever transfer to the ILS market in 1994. So I think we're in a good shape. I cannot really speak for general because I believe that the nuances are indeed very different. And I've heard generally it's a challenge task to get the quota shares support. From our perspective, generally, I believe we will manage to stay pretty much at a similar level as we were. Maybe one of it, which is very strong on our side, it's really the alignment of interest. That doesn't matter where in the group a contract comes in. If it's within a certain frame, it goes through the case the same percentage. So it's no pick and choose. And I think over the years, the good and not years, this has proven quite well. So from that perspective, for our placement, I'm reasonably optimistic. Generally, I think it is a good timing to get into the market, whether this is now into a sidecar, into an insurer, into a startup, or into us. I think it depends also of individual circumstances and requirements. A startup costs money. You need to have the know-how, and you can't get out the money quickly. If you go to an existing reinsurer and buy stocks, are fully subject to the financial markets. ILS, you are reasonably separated from the financial market, so the diversity case is true. And unless you have losses, you can get out the money fairly quickly again. So various ways of getting in and out, and it depends a little bit on individual circumstances. On the sidecar in general, as I said, you have very nuances and different ways to structure it. Apparently have come up with a lot of losses which haven't gone too well with investors. I'm not really close to a lot of these. I believe that this long-standing case sessions for Hannover will stay a good shape.
Great. Thank you, Henning. So let's move on to discussing a slightly different topic, sort of private equity raises and startups within reinsurance in general. We've seen quite a few traditional reinsurers growing their capital base, or at least plugging any holes that were in them, and more perhaps rumored than successful startup raises so far, but they're beginning to come, and we're seeing quite a lot of money entering the space. And actually, when you look at sort of raw capital destruction, you'd actually think that perhaps the capital has been more than replaced by now already, which means obviously the industry is not undercapitalized at all right now. But do you think the opportunity to raise new capital and launch new reinsurers is actually a particularly good one right now, or even actually required in this industry? Greg, I'd be interested in your view.
Well, it's definitely a fascinating topic, because the old model in the 90s and early 2000s was anytime there was a disruption in the market, capital would come to the market in the form of private equity, and that private equity that would ultimately go public and form, the class of 2001 and 2005 and so forth, as we're all familiar with. And I think most people thought that model was dead, and that when capital would come to the market from 2006 onward, it would just come to ILS or cat bonds or sidecars, and it would stay for a few years and then leave. So it's definitely interesting to see this kind of new wave of capital going to both existing and new entities. I believe at last count, it's something like $8 to $10 billion has been raised for existing or new companies, is my understanding. And for the existing companies, it's interesting because obviously liquidity is abundant. Capital's flowing, and it's easy to access capital right now in the world. So it seems to me that part of that capital raise is likely defensive. Shoring up past reserves, shoring up the balance sheet, a lot of uncertainty around COVID as it relates to, jump risk, if you will, related to court cases that go the wrong way. That's not the expected case, but if that were to happen, having some extra money around to handle that might be useful. So I think part of that raise was probably defensive, and part of it's likely offensive, and that the market pricing is pretty good, and it's a good time to deploy some new capital. So who knows what the percentages is, call it 50-50, but, something like that. Then for the new companies, again, very interesting that these companies are starting. There are some credible management teams out there that are moving and starting these. They certainly have management experience. I would say these are relatively small capital raises in the scheme of things, from what I can tell. They're certainly going to be diversified companies, and it's going to be interesting to see how they compete with the incumbents. The established players, the people who've been there a long time and might have more resources and more relationships and with more bandwidth. So, how they compete, what their edge is going forward is going to be interesting to see. One thing I'll say for both models, whether it's existing or new, is they're both going to be subject to the rating agency constraints. So with those constraints, they'll have to be diversified. So my point is, if it's $10 billion of capital, part of that's defensive because it's existing players and showing up balance sheets, and part of it's offensive. Not a lot of that's going to find its way to the catastrophe market when you break it all down and look at the rating agency forcing them to diversify outside of catastrophe. So there's nothing wrong with it going to other lines of business, but as it relates to ILS and catastrophe, which is more the purpose of this panel, I don't think $10 billion is coming to catastrophe. I think part of it's defensive, and part of it's going to be diversified because of rating agency constraints, and certainly a portion of it will, but may not have the impact on the catastrophe market that the headline number would suggest.
Sure. Yeah, no, it does seem like the capital is not going to be all flowing to one place for sure. I guess it's interesting that some of the strategies behind the startups appear to be sort of nothing particularly new or innovative at this point in the cycle, which might seem a little disappointing, I guess, to some, that we'd think with technology and things like that perhaps we'd see something more new, more innovative coming to market. But maybe that's something we'll see further down the line as the opportunity really sort of pans out through 2021. As we look ahead into sort of the year coming, and obviously ILS funds are obviously raising capital at the moment for year end. Reinsurers have largely raised the capital they need for year end and now focused on renewals. But looking ahead into 2021, with the environment clearly hardened and rates being much better, where do we think investor appetites are going to be sitting at this point, sort of through next year? Do you think we're in for a period of growth in the ILS market and also more startups on the reinsurance side potentially? And I'll turn to Greg first.
Yeah, and I think capital is going to flow. Investor interests are so varied. Some people have high risk appetite, some people are low, some people like liquidity, so they gravitate more towards the top-on market and so forth. I think investors will just be more discriminating, and they'll go where the opportunity set is most relevant for them. I do think it's challenging to raise capital right now. I think cat bonds have had a really good performance period, but over time, again, there are certain places where cat bonds outperform. There are certain places where collateralized reinsurance or sidecars would outperform. So investors just have to understand that. So I think there's just a variety of ways in which people could participate. I mean, obviously spreads have widened, rates have gone up a lot the last 3 or 4 years. But I do think it's important to investors to understand that, that's not all just cyclical. There's been loss activity and so spreads are widening. We think a lot of this is structural, and that the market is repricing for things like climate change, repricing for model uncertainty as it relates to claims development from Hurricane Irma and other things, and trapped collateral, people pricing for trapped collateral needing a return on, some probability that the collateral is trapped. So just because spreads have gone up a lot in the last 4 years, it doesn't mean it's a cyclical, opportunity to just plow in and it's all gravy. Part of that probably should have been priced before, and we think a lot of it should be structural and continue going forward if the market's responsibly pricing risk, because all the things I just mentioned are relevant to the risk assessment and making sure you're an appropriate, return on your capital. One thing I failed to mention on the equity companies a minute ago is the great thing about that is, when capital comes to people like the people on the call right now, that's generally a lower cost of capital than equity capital. If there's $10 billion of capital that's been raised, as we talked about in the previous question, all of that requires an equity cost of capital and equity-like return, which certainly is good for pricing in the market. So those would be my initial thoughts.
Sure. Thank you, Greg. Moving on to John. What's your expectation into 2021 and investor sort of appetites and motivation within insurance and reinsurance?
I think, definitely I agree with Greg's comments in terms of there will be a flight to quality, essentially. I think investors have, a broad view of a market which has now been tested quite strongly across the board, and they will see the relative performance of different participants in different areas in the market. I think in a market which is more broadly hardening, this is not just an effect in the catastrophe market, but it's across all lines, certainly on the P&C side. Then we will see, investors move into the various sectors which suit them best structurally. But I think probably some focus away from pure catastrophe risk, which is maybe why we're seeing more of this capital flowing into, the top-ups of the existing reinsurers and maybe a very small number of startups compared with the ILS funds at this point. The last few years have maybe tested some of the structural issues for the ILS markets that we still have to resolve ultimately, in order to have the same level of appeal to the broad base of investors that investing into the traditional balance sheets already do. I think we will see some effect rolling forward of structural changes in the market, but it will be slow and incremental. We're really at the start of these technical changes in the way that the insurance markets are structured. But ultimately, I think there will, over the next 5 years, certainly be more of a structural shift than we've seen for a very long time in terms of the traditional layers of capital in the market. And it will be interesting to see investors filtering their way through that structural shift and seeing how they wish to deploy capital moving forward. But I think we will see certainly more attraction towards a multi-line deployment of capital. We will see people, I think, still looking towards good, solid, well-performing franchises, but also thinking about how they will evolve and who the new rising dominant players will be. And I don't think that's necessarily new people doing the same old thing. I think the successful new participants will be doing things differently. So maybe that's why there's some skepticism about some of the old traditional but newly formed platforms that we're seeing now.
Interesting. Thank you, John. And then moving to Stefan, as we look towards year end and into 2021, what's your outlook for investor appetite going forwards?
I'll try to build on what Greg and John have brought up, actually. What I think we're seeing, actually, we see on the one end of the spectrum an exploitation play of a lot of investors. And on the other hand of the spectrum, we do see an exploration, let's say, focus. And I think there's everything in between. And when I say exploitation, I'm speaking really about predictable outcomes, about known structures, about things that have proven their track record. And obviously, cat bonds are part of that exploitation play, actually. And we have seen interest, and we will continue to see a lot of investors, let's say, staying within something they know, they've understood, and that has worked. But then you have a number of investors that come back and now start also opening a door for more exploratory play. And the exploratory play can go into broader ILS strategies if they structure well and show the lessons learned from the past 3-4 years. But then they go into the private equity sector, where we do see, and we've spoken about, quite some interest and money coming in. And then obviously to the extreme, on the exploratory side, you have seed capital for insurtechs, you have seed capital or venture capital for ventures that are technology driven or are, let's say, new ventures in the sense of they're covering risk that's not been covered before. So I think it's very hard to predict, and I think it's about to know your investor's base and what to offer to that investor base so that they can really understand where they sit between exploitation and predictability of outcomes towards the exploration, where you have really probably high possible returns, but also a certain risk of failure. I think it comes down to what you call the alignment of interest. The alignment of interest with the manager, that's the fiduciary of the money, or with the management team, or let's say the capital providers and the management team when it comes to build new structures, actually. So, but to summarize, at the end of the day, what we see is rising interest for, let's say, ILS structures that are predictable in outcomes.
Thank you, Stefan. That's actually a very good summary because it ties in well to the flight to quality that's been well documented, the flight to simplicity that's being talked about as well, but also the potential opportunity for people who really do have something new, innovative, and structurally different to offer to investors as a way to enter insurance and reinsurance, which hopefully we'll see some more of next year. We've actually run over on time, so I'm going to draw this to a close, and apologies to our audience because we didn't manage to get to any of your questions today, and apologies also for the fire alarm break where I had to run away for a few minutes. I'd like to thank our speakers today for their participation: Stefan Ruoff from Fraudus Aguero, John Butler from Cohen Company, Greg Hagood from Nephila Capital, and Henning Ludolfs from Hannover Re. Thank you all, gentlemen. Really appreciate you being part of this today. Thank you to those who dialed in. We will be back tomorrow. We have 2 more sessions, full details on that on the event website. So thank you once again to the panelists, and thank you to our audience for today.
Thanks, Steve.
Thank you, Steve.
Bye-bye.
Thank you.